Hey guys, Brian Stevens over here at Mortgage Shots and the National Real Estate Post. You're looking at Mortgage Shots right now. If you're not, you should go over here and subscribe. You'll get our show. Hey, listen, today I want to talk to you guys about a couple of things that I think are wildly important that just kind of drop it. There's a backstory that goes to this. That is a direction that the market is going to go. It started back with quantitative easing. Quantitative easing has been the bane of our existence as far as I can tell. I want to show you something here real quickly. Who stole the American dream? Ben Bernanke. $1.54 trillion in mortgage-backed securities via quantitative easing. It's where they went and bought every mortgage-backed security. And why would Ben Bernanke go buy every single mortgage-backed security? Well, for one reason, nobody was interested in buying these in the private sector at the time. So who was going to buy all the mortgage-backed securities? Well, the Federal Reserve went in there and Ben Bernanke spent $1.54 trillion. Now, what happens when we buy mortgage-backed securities? Well, it's supply and demand. And so when we have all that demand and we have a ton of supply and we go out there and spend a bunch of money, that means we are creating a huge amount of demand. And demand is always going to drive the price of that good. It could be a banana, it could be pork bellies, or it could be mortgage-backed securities. It drives the value of that commodity down. And then we see interest rates drop. What happened with Ben Bernanke? Well, this was right during the meltdown in 2008. We drove mortgage rates down as a means of kind of keeping the mortgage and real estate market afloat. Janet Yellen, same thing, $1.77 billion in mortgage-backed securities via quantitative easing. And of course, with Jerome Powell, $403 billion in mortgage-backed securities, quantitative easing. And if you look at this graph from the Federal Reserve, we can see where these bumps are at, each one of these bumps. How the Federal Reserve stole the American dream by artificially inflating home prices by manipulating interest rates. You see, we have a market right now that has home prices based on interest rates at 2.5% and 3%. So when rates are 2.5% and 3%, that means I've got more purchasing power. And that purchasing power allows me to drive the price of homes up because I'm going to buy a house based on my ability to make a payment, not the sales price, but my ability to make that payment. So when rates are lower, I can afford more house. So when interest rates go up to 7% and 8%, well, my buying power goes down. Well, now we have a market where prices are based on rates at 2.5%, but we are now selling 7, 6, 7, and sometimes even 8% interest rates. That means nobody can afford to buy those homes because our purchasing power has gone down. Only now are we starting to see home prices drop. That's why I have a really big concern about a couple of things that are taking place. Now, this just came out last week. But the federal and the governor installed by Trump outlines a bold case to slash interest rates to 2.5% in months. Well, we certainly like that idea, don't we? Because that's going to mean we'll bring more buyers to the table. But that means we reboot this irrational cycle of artificially low interest rates, which will invariably go up and put us in the predicament once again that we find ourselves here today. Donald Trump's pick to join the United States Federal Reserve said on Friday that he disagrees with other bankers over the decision to slowly cut interest rates. Instead, Stephen Moran, the recently appointed and Trump-backed governor, said rates should be cut as much as by 2.5% this year. The recently appointed governor's comments came less than a week after he disagreed with all 11 other decision makers at the Fed. Last Wednesday, America's central bank decided to cut rates by just 0.25%. Now, obviously, the trend of the Trump administration right now is to go ahead and cut rates. And I know that interest rates don't necessarily have a direct correlation. The Fed fund rate doesn't have a direct correlation to mortgage interest rates, but they seemingly kind of go hand in hand. And if the Fed starts to go back into quantitative easing to lower interest rates to stimulate the economy for a recession that I believe we've been in already for the past 6 months, and we will find this out in probably the next year or so, that we're already in a recession, we're certainly in a housing recession, we will simply reboot the situation that we're in right now. So do we like this idea or do we not like this idea? But let me show you one more unintended consequence of the policies that we put in place over the past couple of years. Now, this one, guys, really shocked me. But look at the first one over here. Total U.S. Loan delinquency rates. That means 30 days or more late, past due, but not in foreclosure yet. Those numbers are up. Let's go year over change. It's up 2.9%. Let's go to the second one over here. Total U.S. foreclosure pre-sale inventory rate. Now, the pre-sale inventory rate of foreclosures is year over year up a whopping 10.4%. That is a huge number. Now, let's look at this one. Total U.S. foreclosure starts year over year. We are up 5.82%. Monthly prepayment rates up 5.81%. Now, this one is the one that really kind of knocked me out of my chair and made me spit my coffee out. Total U.S. foreclosure sales. Guys, we are up 22.5% year over year. That is a massive number. Now, the next one is even more shocking here. The number of properties that are 30 or more days past due, but not in foreclosure yet. These are people where the sirens are going up. We are up 84%. Nearly 100% up on people who are 30 days late on their mortgage. The next one there is the number of people who are 90 days late. That's up 32%. Again, a scary number. Number of properties in foreclosure pre-sale inventory up 23%. And the last number here, and what appears to be, I'm going to tell you it's not, but appears to be a very, very depressing number of statistics here. The number of properties that are 30 or more days past due or in foreclosure is up 107%. But you see, this is a direct reflect of the policies of the last three Fed chiefs. This is the policy of the last three Fed fund chiefs. And it has worked out exactly the opposite of what they intended. And yet now we have an administration that's talking about going down the same policy. And again, I'm not a Trump hater, guys. In fact, if anything, I was very optimistic, am very optimistic. I always root for our country about some of the things that Trump was doing. I don't know right now if this is a solution. Listen, I understand right now that we are in a superlative market where we have a record low number of sales, low number of inventory, low number of buyers. I get this. I get that we need to have a solution here, but we can't keep going to the well. All right, here's an interesting one. Jobless claims tumbled to 218,000, well below estimates despite fears of labor market weakness. So jobless claims right now. And here's another interesting one that I wanted to bring up to you guys as well. So check this one out. So this, very similar to the article I just showed you. This is from Fred. Fred is the Federal Reserve of St. Louis, in case you didn't know. And they put out a bunch of fantastic graphs and a bunch of fantastic information. And this one's a great one here. So this is job postings on Indeed in the United States. And this is according to the Federal Reserve. So job postings are down. They're significantly down. They're way down. Look at this. I mean, we're going back to 2024. We had 1.13 million job openings. And look at where we're at right now, 1.4. Job openings have fallen off a cliff. That must mean that we have full employment right now, that employers are happy. As a result of this, the Fed should be leaving everything alone because the economy looks good and we don't need to do anything to stimulate it. However, I want you to think about this. Right now, we don't have employers posting jobs, otherwise looked at as a positive thing, meaning we're filling those posts, right? We're filling those jobs. But what do you think is really taking place? I want you to think about yourself. I think about myself with this. Are you eating out as much as you used to? I'm not. I mean, it's too expensive. We know when this all happened. It's become cost prohibitive to go out and eat. Are you going on vacations as often as you have? Are you going to concerts as often as you have? Are you staying at hotels? Are you traveling as much? All of these type of things have become so much more inexplicably expensive that people aren't doing it as much. So what happens with the employers who provide these services? If you can't scale your business up and you have to scale your business down, you're not going to be hiring people. If anything, you're going to be laying people off. But what you will not be doing is posting jobs. So what we look at as a positive thing, we've got flush full employment right now, everybody's happy. Truth of the matter is, it's because people simply aren't spending as much money as they have in the past. This is why we find the 30, 60, and 90-day lates on mortgages. People, if they're not making their mortgages, I got news for you, they're not going out to eat. They're not going out to eat dinner as well. Okay, another point that I wanted to bring up to you that I thought was pretty darn interesting, and you guys tell me what you think, is this one right here. Boy, I saw this one, and I don't know if you've seen these in your market. We're certainly seeing these out here in California. And it's not just Lennar, it's all the builders who are doing these things. But they're building homes right now, investor-ready homes. When was the last time you heard of a new home subdivision going up that was intended to be purchased by non-owner-occupied folks, by investors? Now, yesterday we told you that institutional investors only represent about 13% of the investment market. Did you know that? Everybody's concerned about the BlackRocks, the State Streets, the Vanguards of the world going out there. You know, the Chinese, the Canadians, whoever it is coming out here, investors, and scooping up, all of our properties. So we, the poor old middle-class American can't buy a property because the prices have been driven up too much by institutionalized investors. They only represent about 13%. 84%, somewhere around 84% of investment properties in the United States are owned by people who live in the United States who own 1 to 5 properties. It's your mom and pop investors. Of course, if you have 5 properties, you're probably a little bit better off than those who've got the one or two properties. So don't you find it interesting that our new home builders are going out there, the Pultes and the Lennars and the Cenas of the world, and they're actually marketing their new home subdivisions to investors, specifically not to for owner occupancy from, again, your Jane and Joe American buyers. This is a tectonic shift, isn't it? So why are they doing this right now? Well, the reason is very simple. Because our new home builders out there right now do not have the confidence, nor do they have the numbers that would suggest that people are going to go into these subdivisions and buy these properties to be owner-occupied. They're not owner-occupied. So they're looking towards non-owner-occupied investors to go ahead and pick up some of these properties that are not currently moving. But there's programs that we have, and by the way, you should be joining my team. If you want to talk with me about joining my team, just leave it in the comments down below, or go ahead and send me a message at my phone number, which is right here, Brian Stevens at 707-330-1272. But one of the strategies that me and my team have over at CB Loans inside of Loan Factory is we have these buy before you sell programs. Now, what that allows you to do is somebody who's got a house that's been sitting for 60 days, 90 days, they're trying to sell it, and they can't sell it because it's not moving, because it's overpriced, because it's based on a market that was set with interest rates at 2.5%, and we're sitting somewhere in the sixes right now. That's why everything I outlined up until this point, properties are sitting. How many properties in your market are sitting for 60 days? The answer is all of them. How many properties are sitting for 90 days? The answer is most of them. However, for people who want to buy a house going forward and they're ticked off right now with their current circumstances, we have a loan program in place where they can go ahead and buy that house. They can buy the house going forward. They still own their existing house. They don't have to make a payment on their existing house, okay, for up to a year. It's going to gather interest on it. They're not going to have there's going to be no negative impact or report on their credit report in terms of late payments, because the lender's going to come in and deal with that loan. They're going to portfolio that loan after they pay off the existing lien, and they're going to allow you to buy the house going forward. You got a year to pay it off. So what we could do is we could go to the Lennars of the world and say, we got some people who are looking at your houses. They want to buy these houses, but they have to sell their house first. Well, they're not going to be able to sell their house. So we have a program that will allow them to buy your brand new, shiny, beautiful Lennar home prior to selling their house. Would you like me to be your in-house lender or one of your preferred lenders of choice? And frankly, I think I'm going to get a lot of them to say yes. Lennar is desperate to move these homes. Lennar is desperate to keep their earnings up. Lennar is desperate to keep their stock prices up. And in order to do that, they need to build and they need to move homes. And they need creative lenders like me who are going to go in there and provide buyers with solutions to the problems that we are facing today. So have you seen these new home builders doing the same type of thing in your neighborhood? I saw this. I was driving down the road and it says, hey, homes for rent. I said, oh boy, well, this is really interesting. They have a whole new home subdivision that they're trying to sell. They said, screw it. They turned the whole thing into rentals because they couldn't sell them. This is a consequence of the market that we're in right now. And this is precisely the reason why I'm concerned when I see things like this, that a Fed governor installed by, it could be Trump, it could be anyone, outlines a bold case to slash interest rates to 2.5%, to 2.5% in months. My friends, that would be nothing short of a shock to our system, and it would have negative long-term impacts. Happiness in the short term, but painful in the long term. Listen, this is very, very important for us to be talking about going forward, because this is going to define the market over the next couple of years. And frankly, I've seen it's going to define the market for up to the next decade. What do they say about, the future or history? What is it? Something to the effect of, if we ignore history, it tends to repeat itself. Well, that seems to be the direction we're going right now. But most importantly, I want to know what you guys think about this. Put it in the comments down below. And of course, as always, if you share this, if you like this, and if you participate with me, it helps me bring more great content to you. With that said, I look forward to hearing from you guys. Again, my name is Brian Stevens with Mortgage Shots. And give me a ring. Let's find out what's going on. Hope to hear from you soon. Bye.